All right, let's jump right in. Today, we're going to talk about a super powerful and totally free tool that answers two massive questions for any investor. One, is your stock getting a little too expensive? And two, and this is a big one for all of us in India investing in the US, what's your real profit in rupees? All right, let's get into it.
So here's a little secret I bet you didn't know. That huge return you see on a stock like Nvidia, the one everyone's talking about? Well, for Indian investors, it's actually not the full story. In fact, you probably made even more. And by the end of this quick explainer, you're going to know exactly why and how to find that real number for any US stock you own.
You see, the problem is actually pretty simple. When you invest in a US stock, you're buying it in dollars, right? But you live here, you spend in rupees. So that number you see everywhere, the USD return, it's only telling you half of what happened. It completely misses this massive tailwind that's been pushing your returns higher without you even noticing.
So that leaves us with two big questions we need to tackle. First, how in the world do we figure out our true rupee return? And second, how can we use this same idea to find amazing companies where the stock price just hasn't caught up yet? We're going to answer both, and we'll be using a totally free Chrome extension to do it.
Okay, first things first, let's tackle that second question, how to find those potential hidden gems. The logic here is actually super simple. All we need to do is compare how fast the stock price has been climbing versus how fast the company's actual profits have been growing.
And this is really the fundamental question you should be asking yourself for every stock you look at. Has the stock price kept up with the business, or has it maybe fallen behind, or even has it gotten way too far ahead of itself?
And this slide just shows it perfectly, the two extremes. Look at M&M on the left. Over 5 years, its profits grew by a crazy 113%, but the stock, only 32%. You can see the business is just leaving the stock price in the dust. The tool calls this catching up. Now look at Polycab on the right, it's the total opposite. The stock shot up 43%, but the profit growth was only 21%. In this case, the stock is running ahead of the business. So how does the tool figure this out? It all comes down to a super simple ratio. You just take the stock's growth rate and divide it by the company's profit growth rate. That's it. This one little number tells you the whole story of whether the market is paying attention to the company's performance.
And this is where the extension just makes your life so much easier. It does the math and gives you a simple batch. So if that ratio is less than 0.7, meaning the stock is seriously lagging behind the profit growth, bam, you get a catching up batch. That's where you might want to start digging for opportunities. On the flip side, if the ratio is over 1.3, it gets flagged as running ahead. That's a pretty clear signal that, maybe the stock is getting a bit overheated. Okay, so figuring out if a stock is running ahead or catching up, that's one part of the puzzle. But now we get to the other, and honestly, the more important part for us here in India. Let's finally figure out what your actual profit is. Let's unlock that real rupee return. Just look at this number for a second, 27.8%. What is that? Well, that's how much the Indian rupee has weakened against the US dollar in the last 10 years. And what that means for you is every single US stock you own got an almost 28% bonus return, completely automatically. It's just sitting there, on top of whatever the stock itself did. It's this powerful hidden tailwind that's been working for you all along.
And figuring out your total return is actually a really simple three-step process. First, you start with the stock's performance in good old US dollars. Then, you add in that extra kick you get from the dollar getting stronger against the rupee. And boom, what you get is your real total rupee return.
Let's make this real. Take a look at Amazon. The extension shows us a fantastic 3-year return in dollars, 122.8%. Great. But now, look at the line right below it. The dollar boost from the currency move added another 4.6% on top. So your actual total rupee return wasn't 122, it was 133%. So what does that actually mean for your bank account? Well, if you'd invested 1 lakh rupees in Amazon 3 years ago, you'd be looking at about 2,23,000 based on the dollar return alone. But with that currency boost, you'd actually have 2,33,000. That extra 10,000 bucks, that's pure profit, just from the currency exchange. Okay, now a really quick but important point on accuracy. For big, stable companies like Meta, this tool is incredibly precise. We actually checked it, and its calculation was within just 5 percentage points of what you'd see on a brokerage platform like IndMoney. That's really good. But for a stock that's been on a wild ride like Nvidia, you should think of this 3-year number more as a directional guide, not a down-to-the-last decimal calculation, okay?
All right, so let's say you found a stock that the tool has flagged as catching up. Awesome. But
How do you know if it's a real opportunity or just a business that's in trouble? That's where the final section on risk metrics comes in to help us make a smarter decision.
Okay, let's put this into practice. The extension is flagging L&T Technology Services as near 52-week low. And you can see it right there. It's trading just a tiny bit above its lowest price in a whole year. This is exactly the kind of situation we're talking about, and it leads us to that one big critical question.
Is this a bargain that the market is just completely missing, or is it what they call a falling knife, a company with some serious problems that you really don't want to try and catch? So how do you figure it out? You don't guess. You use a simple 3-point checklist. Number 1, check the company's fundamental health score. Is the business itself strong? Number 2, check its interest coverage ratio. Can it easily pay its debts? And number 3, look at its current valuation. Is it actually cheap compared to where it usually trades? If you get 3 green lights here, you might be onto something really good.
Now for US stocks, the tool also gives you a bunch of technical indicators that traders often use for short-term analysis. You can see here for Visa, for example, it's flagging a bearish chart pattern. Now, these can be useful to look at, but they should never be the main reason you buy a stock. And that brings us to maybe the most important rule of all.
And I really want you to burn this into your brain. A cheap price is never a good reason to buy a bad business. No chart pattern, no low valuation, nothing can save you if the company itself is fundamentally broken. Always put the business fundamentals first.
The tool we've been walking through today is called the Finmagine Financial Chart Builder. It's a totally free extension you can grab from the Chrome Web Store. It works on Screener.in for all your Indian stocks and on StockAnalysis.com for US stocks.
And hey, if you found this breakdown helpful, do me a favor and subscribe to the channel. We break down one new tool or investing idea just like this every single week, all designed to help you become a smarter, more confident investor.
So I'll just leave you with this one thought. You now have the key to unlock your portfolio's true performance. The only question left is, what's the real rupee return you've been earning on your US stocks this whole time? Go find out. Thanks for watching.